Right. Good morning, ladies and gentlemen. Thank you for joining us for this webinar. We should get started at 10 o'clock. We have activated the webinar to go live now, but we would actually start at 10. Well, that would allow more people to join in, and then we'll get started, and hopefully we look forward to a very useful and informative session.
So are you sending the questions?
I will send you something shortly.
All right, thank you.
All right, it's 10 o'clock, Lagos or Nigerian time. Good morning, ladies and gentlemen, and welcome to the 2024 Norrenberger Economic Outlook webinar. My name is Wale Famrewa, and I have the pleasure of being your host and moderator for today's event. And navigating the Nigerian economy lately, I'm sure many will agree, feels a little bit like driving through Lagos traffic. It's challenging and sometimes unpredictable. But with the right strategies and a little patience, you eventually get to your destination. And that's precisely what we're here to discuss: the strategies to navigate the economic terrain effectively and make the most of your journey in Nigeria right now. So the theme for today's event is Beyond the Reforms. It aptly captures our goal, which is to not only assess the impacts of these changes, but to look forward and identify the opportunities that lie ahead for us as individuals, businesses, and as a nation. So we'll begin our session with a welcome address. That will be followed by a goodwill message and insightful presentation on Norrenberger's Economic Outlook report. And then we'll dive into a robust panel discussion featuring some of the brightest minds in the industry that understand where it pinches right now and what the authorities and key actors are doing to make the most of the opportunity. Of course, we would also invite you all to share your questions, and we'll look forward to you engaging the esteemed panelists later on. So to now formally kick off today's proceedings, it's my pleasure to introduce Mr. Tony Ede. He is the Group Managing Director of Norrenberger. Tony, as many of you would know, is the visionary leader at Norrenberger with a wealth of experience in financial services. He will provide us with a warm welcome, and that would hopefully set the stage for our discussions today. So on that note, I'll hand it over to you, Tony.
Thank you very much, Wale. It's been a pleasure having you, as always. I want to especially say a very good morning to our distinguished ladies and gentlemen that are on this panel today, and the general participant. Especially, I want to also thank Prime Regulator, the DG of the Securities and Exchange Commission, in the person of Dr. Emomotimi Agama, our exciting panelists, and in general, our participants. It is my pleasure, honor, and privilege to welcome you all to the Norrenberger Economic Outlook 2024 webinar, with the theme, Nigeria Beyond the Reforms, H1 Review and H2 Projections. On behalf of the board, management, and staff of the entire Norrenberger Group, I extend my gratitude for your presence today. The purpose of this webinar, as Wale has said, is to share perspectives on the current economic landscape and hold conversations on the potential challenges and opportunities that lie ahead. Our objectives for this event are clear: to provide valuable insights, stimulate informed discussions, and contribute meaningfully to national discourse on economic growth and development. Today's discussions will be anchored on our highly anticipated economic outlook report for H2 2024. This report, which will be launched this morning, encapsulates our in-depth analysis of key economic indicators, trends, and projections. It serves as a roadmap for businesses, policymakers, and individuals, and will serve as a guide to making informed decisions in a rapidly evolving economic environment. The significance of this economic outlook event cannot be overemphasized. For businesses, staying ahead of economic trends is crucial for survival, strategic planning, and sustainable growth. For individuals like myself, understanding economic shifts can aid in personal financial planning and investment decisions, and on the overall, assist in general wealth creation. And for our country at large, a well-informed populace is instrumental in driving collective progress and national prosperity. We are privileged to have a distinguished panel of experts who will share their insights, their perspectives, and their experiences on various aspects of our economy. Their expertise will not only shed light on the current situation, but will deepen the discourse towards creating a sustainable course for the future, for ourselves as individuals and for Nigeria as a nation. As I wrap up, I encourage everyone to engage actively in today's discussion. Let us leverage this opportunity to expand our horizon, challenge our thinking and our assumptions, and contribute to a more robust and resilient economy. Thank you once again for joining us. I wish us all an enlightening and productive session. It's our pleasure having you on board. Thank you.
Thank you very much, Tony, for your insightful welcome. We really look forward to the engagement, and we also appreciate Norrenberger for convening this very important meeting. Next, we'll have a goodwill message from a distinguished leader in the financial sector. It's my pleasure to introduce Dr. Hassan Suleiman, who is representing Dr. Emomo Timi Agama, the Director General of the Securities and Exchange Commission, Nigeria. Dr. Suleiman is the Assistant Director and Head of Economic Research and Intelligence at the SEC Nigeria. It's a pleasure to have you, sir. It's over to you.
Okay,
yes, we can see and hear you. Please go ahead.
okay, so good morning. As you said, I'm standing in for the Director General of the Securities and Exchange Commission, Dr. Emomo Agama, who unfortunately, due to scheduling, he is unable to make it. So I'm very pleased to present his remarks on his behalf. So we have a distinguished line of panelists. I'm sure we are all eager to hear their insights. So without much ado, I will quickly read his remarks. It goes, ladies and gentlemen, distinguished ladies and gentlemen, welcome to the Norrenberger Economic Outlook 2024. It's a privilege to deliver the opening remarks at this pivotal event. The theme for this year, Nigeria Beyond the Reforms, hold profound significance as our nation undergoes transformative economic changes. This gathering serves as a robust platform for dialogue, knowledge exchange, and the exploration of ideas. Together, we aim to shape a Nigeria that is economically resilient, socially inclusive, and globally competitive. Nigeria stands at a critical juncture. While recent economic reforms have established a strong foundation, our journey towards national prosperity remains ongoing. This forum provides a unique opportunity to assess progress, identify challenges, and chart strategies for sustainable growth. Today's discussion promises to be enlightening and thought-provoking as we evaluate our current economic landscape and envision a stronger, more resilient Nigeria for the future, aligned with and actively supporting the federal government's reform agenda. The Securities and Exchange Commission plays a pivotal role in these endeavors. We hold a renewed optimism that ongoing reforms will pave the way for a prosperous nation. Central to this idea is the pursuit of a $1 trillion economy through a new financial inclusion framework. This initiative aims to alleviate poverty and stimulate grassroots economic growth, guided by federal government's ASUA Accord on economic and financial inclusion, ensuring universal access to financial services. The securities market will play a crucial role in achieving the government's vision of transforming Nigeria into a $1 trillion economy by 2030, by mobilizing capital, supporting micro, small, and medium enterprises, financing infrastructure, offering inclusive investment opportunities, and upholding transparency and good governance. The securities market significantly contributes to sustainable growth, poverty reduction, and broader development goals. Today's forum encourages us to look beyond immediate reforms. Through collaborative knowledge and expertise, we can envision Nigeria's future economic landscape and strategize for sustained success. I'm confident that today's session will be intellectually enriching, driven by the expertise and insight of our esteemed speakers and participants. Thank you for your participation and engagement. Together, let us forge a path towards a prosperous and resilient Nigeria. Dr. Emomo Timi Agama, Director General, Securities and Exchange Commission. Thank you.
Thank you, Dr. Suleiman, and we appreciate Dr. Agama sharing his perspective on today's event. And we look forward to further collaborations with the SEC. Thank you so much again for joining us for this and for delivering that address. Now we move to a key part of our sessions today. And as you can see, we are moving very efficiently because we want to get right into the meat of the matter, if you like. So the presentation of the Norrenberger Economic Outlook Report for 2024 will be delivered by our next speaker, who is Abina Yinkere. He's the business head at Norrenberger Asset Management Limited. He's a seasoned expert, economic analysis, investment management, strategy, and all those nice stuff. Known him for many years, and I have no doubt he's going to deliver a very insightful presentation. I'll hand over now to Pabina to deliver his report. Pabina, it's over to you.
Okay, thank you, Wally. Greetings to our distinguished guests and to our fantastic panelists. I'll say welcome. It's good to share this space with you all. In the next 10 to 15 minutes, I'll touch on major highlights in our economic reports, the Norrenberger Economic Outlook, Nigeria Beyond the Reforms. So key sections of these reports are highlighted in my presentation. Sorry, I'm having a little delay in the presentation slides moving. Okay, great. So key sections of this report is highlighted in this presentation, and at the end of it, it will lead into the next session of discussions, which will provide robust perspective and views on Nigeria's economy and going forward. If you look at the world today, as you traverse from east to west, a myriad of issues are happening around the world, whether it's the geopolitical conflicts in the east or the economic renaissance that is happening in Middle Europe, or the key events of inflation and challenges with security happening in sub-Saharan Africa. But I think the most important global event to keep eyes on is the forthcoming presidential election in the US. As we already know, the president, Joe Biden, has stepped down. And in stepping down, he has nominated his vice president, Kamala Harris, to champion the Democratic cause. But of course, that needs to go through a selection process to determine if she will indeed be the flag bearer for the Democrats. It is important to the world to see who champions the biggest economy of the globe today in the next couple of years, whether it be a Democrat or a Republican. And we know what the implication of this would have on various policies and economic outcomes for varying regions across the world. If we look at Nigeria today, the economic scorecard is not a very pleasant, it's not a very pleasing scorecard, I would say. We've had a myriad of challenges from inflation to exchange rates, devaluation, and even issues surrounding unemployment, how that continues to trend up. However, amidst these, we can also highlight some of the positives we've seen. If I would highlight a couple of that, those would be things such as the growth in external reserves, which is green on the slide showing, and improvement in capital importation from the devastating lows that we've seen over the last few years. I think those are some green shoots that are coming out of some of the necessary difficult decisions the country has had to make. Nigeria's growth, while still low in some sense, you would say, but I would say it's still a miracle to see that we are able to turn out growth figures out of the current situation we've been through in the last couple of months. Like I earlier highlighted, we've seen rapid inflation across the country. We've seen significant exchange rate devaluation, which is having significant impact on a lot of businesses. But you can see that the economy is still able to turn out some growth figures. Chief of the resilience you can see in the Nigerian economy is being driven by the oil sector. As you can see, we've had a recovery in oil sector since the second quarter of 2023. We've been able to raise our oil production levels to near 1.5 million barrels per day. Whilst this is laudable, it still falls short of the budget figure of 1.7 million barrels a day. And I think we still have some catching up to do with that respect. Now, this slide is particularly interesting because if you look at Nigeria's sectors, the largest contributors to GDP appear to be the ones that are most sensitive to interest rate and exchange rate shocks. So if you're looking at sectors such as agriculture with 25% contribution to GDP, or you're looking at the trade sector with about 16% contribution to GDP, and even the manufacturing sector with 8% contribution to GDP, these are the sectors that are most badly hit, by the exchange rate and interest rate decisions that the country has had to take over the time. And you can see that these sectors are some of the slowest growing sectors in the economy. Inflation continues to be a major headache for the country. And as you know, the inflation we are facing today didn't just start from the decisions made today. They are a fallout of many things that have happened over the years, coming from COVID to the war in Ukraine and to the removal of fuel subsidy and the subsequent relaxation, or if I would, the resetting of our exchange rate market into a more competitive, market-driven pricing methodology. All factors that have led to Nigeria's inflation trajectory today. But I think key amongst this is the significant food shortages we continue to face as the country. Now, in looking at food shortages and inflationary impacts on the country, you would see that from this chart, the darker spots represent the segments or the regions where inflation is highest across the country. And you can see that it is predominantly within the southern belt in the country that the inflation has been really tough. Key drivers are high transportation costs, infrastructure deficit, insecurity in the north, and the process of transferring the food items from the north to the south also continues to be challenging for the economy. We've seen the significant depreciation in our exchange rates in line with market reality. That decision itself, whilst many complain about the hardship it has brought to the country, one cannot neglect the fact that it was a necessary evil we needed to overcome as a country. And if you look forward from there on, you can see that the combination of inflation and exchange rate devaluation has pretty much had a significant impact on corporate earnings. You look at key sectors, consumer good, ICT, and the industrial good, we can see that whilst revenues were up strongly, 64% in the first half of the year, cost of sales was even higher at 86%, showcasing the impact of the key items I had mentioned. And of course, the exchange rate devaluation has led to significant exchange rate losses for many of the large firms operating in this sector. Key reforms that have happened over the first half of the year across the fiscal and the monetary space are all in response to the economic situation we find ourselves today. And without mentioning each and every one of them, we can see that key things have happened across fiscal and monetary sides of it. Across the monetary side, we are looking at things that has to deal with how to ensure stability in the exchange rates of the country. As the CBN has released quite a number of circulars and provisions aimed at strengthening the exchange rates and deepening the exchange rate market. On the fiscal side, we are seeing moves to set the economy on a path of growth and address key policy necessities that may need to be unlocked to get Nigeria to where the country needs to be. Now, when you look at these reforms, what are we beginning to see? Are the reforms paying off, or are we having a trade-off? So some of the fallout of these reforms include high prices, insecurity. There is increased poverty in the land, as many would say, due to the fact that the inflation continues to ravage, the currency is depreciating, and we've had quite some divestments from key businesses in the country. But if you look at the flip side, we are seeing things such as improved trade balance. We've continued to post trade surplus due to the fact that oil prices remain positive and our production has been able to improve. And on the back of that, we are seeing increased FAC allocations, which means that our states have a bit more resources to spend across. We've seen improvement in the capital importation, as reported earlier, a significant growth from the levels we've had over the last couple of years. Our foreign exchange reserves is beginning to see some recovery, which is a positive sign. And then we've seen exchange rate convergence across the different segments of the exchange rate market. So going forward, as I begin to wrap up, these are some of our projections on key variables that we expect to happen over the next half of the year. We are looking at the inflation figure, and we think inflation may have peaked. So in the next half of the year, we expect to see inflation taper down, albeit sticky, but taper down a little bit. And we have a base projection that by the end of the year, the inflation figure should hit at about 32%. So we've created in here worst case scenarios and best case scenarios across our across the key metrics we are looking at. And we think that on a worst case scenario, inflation could reach 43%, and the best case scenario, it could cool off to 20. I would speak about the drivers as a whole. So I just want to point out on the figures first. On growth, estimate growth is for a base projection of about 3%. We think that on a best case, we could do 3.6%, and on a worst case, 2.3%. On the exchange rates, we think around 1,450 is a level where we think by December, the Naira should be trading at. On a best case scenario, we think 1,100, and on a worst case scenario, we think we pretty much cross the 2,000 level. On foreign exchange reserves, we think that the base case is that we end the year at around $36 billion. On a best case, 39, and on a worst case, we fall towards 30. Now, what are the assumptions driving these base case, and worst case scenario? And I'll start from our base case. On our base case scenario, we think that if we maintain our current oil production at 1.5 million barrels a day, as the Dangote refinery has come into play, if we think that if some of these issues, as you would all know from, as we've seen in the newspaper lately, there's been quite some agitation, I would say, between Dangote refinery and different other actors in the economy on the full scale and full operations of this refinery. We think that it can help to sustain some of the levels we are seeing. Then, if you look at crude oil prices, we think that we could, given the outlook of demand and supply balance, we think we could pretty much be looking at figures that are nearing 100. But of course, the US policy will be a key determinant in where crude oil prices also go. On a best case scenario, we think that if crude oil prices remain elevated, it's positive for the country. Interest rates will definitely need to remain high to deal with some of the challenges we are facing today. And if we see oil production continue to ramp up from where we've been. On a worst case scenario, we think that global tensions could intensify. We could see further deterioration in tariff, in electricity, in inflation, in prices generally. Crude oil production falls below the 1.2 million barrels a day, negating some of the gains we have seen in the last couple of quarters. And then if the central bank turns dovish as a result of weak economy, and that could also deliver some of the worst case scenarios that we expect to see. So I thank everyone. Presentation has ended here, and I look forward to future discussions in this session. Thank you.
Thank you very much, Babina, for the insights. I'm sure many would love to see that best case scenario with the exchange rates, and we will see, the likelihood of that happening. And certainly, we are hoping that we don't see that worst case scenario. I think that for me was one of the biggest takeaways from the presentation. So we're going to interrogate these points, no doubt, and I want to remind all our panelists, all our attendees, that you are encouraged to also share your questions and comments. And please do so by using the Q&A field of the Zoom platform. And please avoid putting it in the chat field, because it might just get lost in some of the chatter that we may find there. So on that note, I would like to now move on to introduce our distinguished panelists, who would hopefully provide some very valuable insight into the discussion that we want to have about the reform agenda of Nigeria. And so on that note, I'd like to begin by introducing our first panelist, Mr. Ugodre Obichukwu, founder and chief analyst at Nairametrics. He is a well-respected financial analyst and commentator known for his deep insights into the Nigerian economy. Godre, it's great to have you. Thank you for joining us.
Thank you very much, Wale.
Great.
Good to be here.
Next, we also have Ms. Rukaya El-Rufai, the special advisor to the president on National Economic Council and climate change. She brings a wealth of experience in economic policy and sustainability initiatives, and she will be obviously providing the government's perspective to this conversation. Ms. El-Rufai, it's great to have you join us.
Thank you for having me as well, and good morning to everyone.
Next, we have Mr. Bimbola Babalola, who is head of trading and product at the Nigeria Exchange Group, NGX. He will share his experience on the stock market, the investment climate, clearly very valuable insights as well. It's a pleasure to have you, Mr. Babalola.
Yes, thank you very much, Wale. Nice to be here. Thank you very much.
Next, we have Mr. Segun Ajayi Kader, MNI. He is the Director General and CEO of the Manufacturers Association of Nigeria. He will obviously be providing insights from the manufacturer's perspective and the broader organized private sector. It's a pleasure to have you join us, Mr. Ajayi Kader.
Thank you for having me. It's a pleasure to be part of this conversation.
And lastly, we will invite Pabina Yinkere, business head, Norrenberger Asset Management, to also join the panel session. So Pabina, let's have you join us for this as well.
Thank you, Wale.
All right, so let's get right into it. I will go first to Rukaya. Thank you again for your time. And obviously, the government and the authorities, federal, state, etc., are the ones on the hot seat right now, because everyone is looking to the government to drive the reform. So perhaps a good place to start is if you can just give us some broad perspective on how the government plans to support economic growth. And I know since you are also essay to the president on climate change, perhaps doing so in a sustainable manner as well.
Yes. So, like you rightly mentioned, every government would want to have sustainable economic growth and development, and generally on non-economic aspects as well. Every government would want to ensure there's resilience built in, especially that there are a lot of external factors that are rippling in. When you look at the global trends and you see the polarization happening in societies, elections are showing that the wars, Middle East instability and all that, since we're a fossil fuel-based economy. And even on climate, there is, of course, a large degree of influence from geopolitics and the whole Trump scenario as well, and what that would do. And then when you come back home and you look at the state of the economy that was inherited, there are a lot of fragilities, a lot of big fiscal drainers, and a lot of dependencies on imports, for example, not much productivity, with ensuring self-sufficiency, since we're a big economy, that would dampen some of the pressures on exchange rate. You look at the state of our educational and health sector, which are big also items. You look at, you would agree with me that, and you look at the debt sustainability situation, then it was rising debt service to revenue, not even yet where we are now with the debt to GDP being at 50%. You agree that it's a humongous task that was inherited, and like you said, is a hot seat that honestly I just think it's to continue to pray, to our leaders, because they are faced by multifaceted dilemmas, because whichever way you go. So let me pick interest rates, money supply, and inflation, for example, and this thing. There's excess liquidity, inflation is there, you increase interest rate, you are at a risk of stifling MSMEs in particular. Yes, you want to mop up, but to inject, and that's why you'll see there was the announcement of the fiscal stimulus. And even that fiscal stimulus package of 2 trillion comes with very high risk of exasperating the situation if it doesn't get into those sectors. If the concessionary financing does get into the manufacturing sector, if the cheap interest rate to MSMEs don't get into, and then you have minimum wage, where truly is factual that cost of living standards have gone way high, and the minimum wage but then it can exasperate inflation as well. It can further stifle private. So it's a true hot seat. And you look at, even with debt, you're faced with a situation where you need to do social protection for vulnerable population. You need to put in that concessionary funding, yet you already have very high gearing, sovereign gearing, you have constrained fiscal space, your debt servicing costs are already highly constrained. So the plan, and I can speak for NEC, and the National Economic Council, which is the area that is under my direct support actually to the president, where it's a very important platform that brings in the ministers and the state governors. And I know at NEC where we stand is where we're awaiting the economic plan, a holistic plan from the executives of the economy. Because if you remember, during Buhari's days, former President Buhari, when the oil price crashed, there was the ERGP, and when COVID happened, there was the NESP. So I know that the governors are waiting the holistic intercalated plan. That, yes, we know there's the medium development plan, but a holistic plan, so that the governors can sound out to look at the local nuances and how it impacts at grassroots to this. So there is, those interventions, even with agri sector, to ensure food security. For example, at NEC, we were actively monitoring floods since last year, because you can imagine what flood would do to all the agri investments have done. I know there's a close monitoring to ensure that these last 2 weeks window of the rainy season to really get the impetus out. Then, of course, the fiscal reforms. There is the Presidential Task Committee, on tax. I know the revenues have increased. And when I saw the increase, it's not coming from PPT. It's actually coming from the sustainable revenue streams. Yes, we still there is a need to stabilize the macro situation. You recently saw the MPC, the outcomes of the MPC, and just generally to unlock other sectors, support MSMEs, and ensure that the risks are tackled. And with fuel subsidy, it's to ensure that the local refining capacity gets enabled, and then to fast track and accelerate alternate sources of fuel. And that's really, then of course at NEC there is we have this human capital development program that tries to look at education, health, and labor force participation. It's a program we inherited from the immediate past last NEC dispensation. And we are aware of the high risk to malnutrition. The nutrition is at risk, and even that is being tackled.
Well, thank you for that robust review of some of the various activities that the government is involved in. And clearly we would come back to you to perhaps give us a little more insight into how the NEC is organizing itself to address the pain points. But at this time, I want to go to Ugodre to perhaps give us some perspective on the financial markets, because I think at the end of the day, that's where investments happen. And I think that is one of the biggest values that I think this engagement can provide. So over the past 6 months, we've seen significant reforms, policy shifts from the monetary and fiscal sides. With these changes, I wanted to hear your thoughts on the overall take on the financial markets and where they're headed. Perhaps you can give us high-level views on what you're seeing, and especially from an investor perspective, where you think the markets are headed.
All right, thanks, Wally. That's a broad question. Anyway, for the sake of the audience, I guess you want to divide financial markets into capital markets and of course fixed income market, especially when it comes to Nigeria. Of course, financial markets are a lot broader than that, but for the sake of Nigeria, it's usually the capital market, which is more like the equities market, and of course the fixed market. So what we've seen is a bit of a what a lot of people would say inconsistency, being like you've seen the equities market up at 30+% in terms of return this year. You've also seen a pretty much bullish fixed income market as well this year, and that is in large contrast to what Nigerians are feeling. So the macros don't seem like the economy is doing well at all. And of course, there are a lot of indicators that support that view. However, in terms of the financial market, investors tend to see things pretty much differently. But why is this happening? The reason is, of course, at the start of the year, I think the impression was that the value of equities was underappreciated, and that was because a lot of people thought that the exchange rates depreciation that happened most of last year and early this year highly undervalued our equities. So by undervaluing our equities, that meant that investors had to point cash there so that those equities could reflect reality. And even despite a lot of the increases that we've seen in valuations, in terms of multiples, stocks are still just sub 15 times earnings in terms of multiples. So that is essentially what has been driving equities market. And of course, on the fixed income side is interest rate. Wally, you know pretty well what has happened on that space with central bank treasury bills giving us a yield of about 29%. You're seeing a lot of funds also flow into that space. So for investors, I don't think that it's been as bad as it is on the streets for them, and that's why we keep saying, look, if you want to avoid this, this experience that we're having in Nigeria in terms of premium shege, as they tend to say on the streets of Twitter, just invest, right? So because people that are investing at the moment are not feeling the pain as much as those that are not investing, and I think that those are just the reasons why it's happening, Wally.
Yeah, thank you. I think perhaps one of the biggest takeaways from what you've said is that regardless, notwithstanding the economic pressures, those who are investing are doing pretty well so far this year. But maybe I can come back to you again very briefly if you can't comment on the outlook though. So we finished the first half, like you said, equities up 30%, fixed income yields for T-bills somewhere closer to 30% as well. Where do you think things are headed from here?
I am positive that the market will end on the positive note this year. Most of the gains will be driven by what we had in the first quarter, of course. I think the second quarter was pretty much flat. Major driver will be, of course, Wally, the bank recapitalization exercise that we're seeing. So a lot of banks and banks make up a huge percentage of market valuation and the equities market. So a lot of banks are already selling at a slight discount to their average market values. And so what you would see is that would, in a way, sort of depress the sort of valuations that you would have seen, or the sort of the valuations that we saw in the first quarter that may have translated into the second quarter. Earnings are going to come out in June. Not sure that we're going to see anything much in terms of increase. A lot of companies in industrial and consumer goods sector are still struggling. So I don't expect to see a lot in that space. Likewise, telco as well. And then on the banks as well, that could do well. You've already seen what's happening with the windfall tax. So I think that a lot of their dividend plans for the second half of this year has already been cut short. And so those are some of like the headwinds that I expect to see in the second half of the year. Be that as it may, but I'm pretty positive that by the fourth quarter of the year, you would see some improvement in equities, and we could close still slightly higher than 30%, Wally. But I wouldn't wager the.
Well, fingers crossed. Let's see. Thanks for the insight. Of course, we understand the thinking behind that. But let's pivot a bit away from investments, at least portfolio investments for a moment, and come to the manufacturers and the organized private sector. So, Mr. Ajayi Kader, if you can just chime in on this point. When Mr. Rufai was speaking earlier, she talked about the fiscal stimulus plan. Let's talk about the challenges you are facing as manufacturers right now and how potentially that stimulus can support growth. Maybe as you do so, help us appreciate where we are at now and potentially what a stimulus can do. And maybe one last question around that is, if the stimulus is not the solution, what do you think is?
Okay, thank you very much. I think the outlook that was presented by Norrenberger has actually made it very easy for our participants to appreciate where we are at, painted very exact pictures, and I'm actually surprised about the similarity in the figures that we have concerning what we think the last half or the second half of the year would look like, particularly in terms of the exchange rate and what we think the interest rates will be. But talking about the manufacturing sector, global perspective has been given. You have rightly given the global perspective. So it is not to say that everywhere in the world we have seen some impact on the manufacturing space, which has to do with the international flow of logistics. We came out of COVID, the Russian-Ukraine war, but the one in the Middle East and the general deglobalization trends have tended to compound international logistics, sourcing of raw materials, spares, and machines that are not available in many local economies. So the manufacturing sector in Nigeria has not been insulated from all of this. Manufacturing is one of the most susceptible sector from international shocks. And so the geopolitics of this world, the scramble for Africa, and the fact that many nations are drifting towards nationalistic policies have impacted economies, developing economies, including Nigeria. At the domestic level, and I think this webinar has been largely focused on the reforms that the administration has come in with, even from day one. And those reforms have tended to impact on the performance of the manufacturing sector. The issues that we confront now didn't start today, as has been mentioned by a previous speaker. But then one must be mindful of the fact that the future is now, and now is the future. So you cannot divorce the two. I think the reforms that we've had, necessary as they are, have left so many challenges behind. And the manufacturing sector being a sector that must be nurtured, I mean, every sensible nation will prioritize the manufacturing sector because there is no economy that can effectively develop and be prosperous that does not have a vital manufacturing sector. Even the rise in tech and artificial intelligence and so on, they are still driven by manufactured parts. For every soft part, there had to be a hard part. So in Nigeria, what we have seen in more recent times is that we have a manufacturing sector that the contribution to GDP has been less than 10%. It is growing at about 1.5% max year on year. We have seen unplanned inventory hitting more than 1.1 trillion naira in 2023. And in the first half of this year, it has surpassed 800 billion. So you can see that even though our production is constrained, consumer purchases has also been quite low. So our manufacturers are investing in hiring warehouses. We've also seen manufacturing growth, like I said, slow down completely. Then we see the impact of foreign exchange, which was floated. One could understand the basis for it because the arbitrage was negatively impacting the economy. But then we needed to see a situation where even with the floating, we are able to prioritize the productive sector such that the rate at which you are sourcing your raw materials, you are sourcing your spares and machines that are not available locally, will be the one that is supportive of your productivity. What I mean is that the volatility in the foreign exchange market should not be allowed to negatively impact production. I mean, we should prioritize it. And more importantly, even the rate at which the import duties on those vital raw materials are calculated, we needed to ensure that they do not follow the trend so that there will be trickle-down effect for low prices to meet the low purchasing attitude of the people that we are seeing. We've also seen an upsurge in fact, a hike of more than 250% in electricity tariff. And you know, we've had these conversations before that for an average manufacturer or for manufacturers, the cost of electricity is between 28 to 40%, depending on how power intensive you are. So if you have a 250% increase in such an area, you can know what the impact will be. And seeing that there is also inflation that has eaten deep into the pocket of the average Nigerian, it will affect consumer purchases. It will affect your capacity utilization, which has continued, like I said, to hover around half of its installed. And then you have
So sorry to jump in. I really apologize because you are providing very valuable insights to help us appreciate where you're at. But because of limited time, I would really like you to speak briefly on the potential solutions. So I mentioned the fiscal stimulus plan. Okay. I wanted to hear your thoughts on whether or not this is something that can support manufacturing and the organized private sector. And if not, what else do you need?
Okay, so we were part of the process of arriving at the stimulus plan. I mean, we did make recommendations to government, and quite a number of announcements have been made as to what funds will be able to support. I think one of the basic support that we are likely to derive from there, which will be very helpful, is the fact that there are some funds that have been earmarked, and it will go directly to assuage the credit that is available to that sector. As you know, interest rates now for an average manufacturer is somewhere between 31 to 35, 36%. And with the recent increase, it's likely to escalate. So we are seeing that one, if it is well managed, I mean, our proposition is that it is given through BOI, because subjecting it to any rate that is higher than 9% or between 7 to 9% is what we are anticipating, and that there should be no hidden charges that will allow us to access it. We are optimistic that if this is taken along with government investment in infrastructure, And if the Fiscal Policy and Tax Reform Committee of the federal government is allowed to kick in, we are at the implementation stage now. All of it will support some second half of the year better performance for the manufacturing sector. We are looking at reaching up to 55% of capacity utilization at the end of the second half.
Right. Thank you very much. So it's useful to know that you are part of the process as well. Okay, I want to now pivot back to portfolio flows. And this time I want to go to the NGX, where Mr. Abimbola Babalola is standing by, hopefully to give us some useful insights. And foreign portfolio investments historically has been a huge part of fixing Nigeria's economic challenges, especially with respect to providing foreign exchange. What are your view the key factors driving portfolio flows right now? And as you speak to that, maybe you can speak to what you have been seeing over the last 6 to 12 months.
Yes, thank you very much, Wale. I think if you look at what we've been seeing, you recall that May 29 pronouncement, subsidy is gone. And I think the market took that and, they ran with it. And that was what we started seeing, that even last year, the index returned over 45%. And year to date, despite the fact that the inflation is high, the market had returned about 34%. And to speak to that, it cut across all the participants in the market, be it foreign portfolio investment, be it institutional investment, local and retail. In terms of their participation, it has gone up, and it has also cut across all asset classes, whether you are looking at equities, whether you are looking at fixed income, or you're looking at other assets that are traded on the exchange. But to your question, what is responsible for this? You will agree that it was not only subsidy that the government removed. They also, there was this deliberate policy on the exchange rate too, to bring it to just one. You could also attest to the fact that government or central bank has also cleared all the backlogs of foreign exchange, especially one that has been verified. Also, we notice a bit of increase in our foreign reserves. All these are pointer and what are responsible. And if you compare that with global, what is also happened, the yield on the fixed income is on the high side. You understand, whether you are looking at commercial paper, OMO, federal government bonds, they are on the high side compared to what you can get in the international market. So these yields are part of the reason why foreign portfolio investment is looking at the market now. They can predict and minimize the exchange rate risk because the foreign exchange is available, and now the market is converging between the market and official market. The range is very short. Also, the indicators we're seeing from the Western world and developed world, their own inflation is coming down. Also, the news around the fact that these developed economy will also be cutting rates. So naturally, funds in America and Europe will definitely be looking for economy where they can get better yields. And Nigeria is providing that. You understand? Nigeria is providing that. And we've also, the elephant in the room, which was the major concern then, is if I bring my money in, will I be able to take it out? That problem has actually been solved. So a lot of efforts on the part of government. And don't forget too, banks are also doing recapitalization. So if today banks need to raise about 4.2 trillion to support the recapitalization program, some of these too we expect will come from Nigeria in diaspora and also from foreign portfolio investment.
Yes, but if you can just speak briefly to the type, maybe some of the data, maybe not as specific as you can, or maybe trends that you're seeing in terms of foreign portfolio flows back to the equity market.
So if you look at before some of these reforms or this regime, you will see that the foreign portfolio investment was about, if you look at what they contributed in 2023, they accounted for about 9.1% of the volume and value that was traded in our market. But year to date, they've accounted for over 20% of that. And if you're looking at it in terms of absolute value, what they did then was about 19.34 billion. And what they've done today is about 458 billion. So if you express that in percentage, it means they've increased their stake in our market on the equity side by over 361%. And they're also doing that across fixed income and other money market instruments, because they also try to maintain a balanced portfolio by investing in all these various asset classes. But the figure that I just rolled out was, focused mainly on equities.
Got it.
So we're seeing an increase in that.
No doubt. Thank you for that. That's useful to know. And I just wanted to point out to all our attendees that we do see your questions. Again, I want to encourage you to please put them in the Q&A field, because I see that some are actually typing in the chat field. There's a tendency for them to get lost there. So again, I want to reiterate that you should please put them in the Q&A field, so that very shortly we should be going there and posing some of these questions to our panelists. But let me go now to Pabina to get his thoughts on the investment outlook. You've painted a very broad picture for us, and you talked about base case, worst case, and best case, especially with respect to the exchange rate. But I want you to speak to the opportunities that you are seeing, maybe being a little more specific. From the equity side to the fixed income side. From the fixed income side, to me, there is a clear case for investment in treasury bills if we can get yields closer to 30%. And then from the equity side, you can just distill for us the opportunities you're seeing going forward. Of course, one of the big ones that people are examining now are the bank offerings.
Okay, thanks, Wale, for that question. So I think a good place to start is what's driving these opportunities, right? The equity market, fixed income market, whether stocks or treasury bills, are all vehicles towards making an investment. So I think what we first need to interrogate is, where are the opportunities? So I'm talking sector-wise now. So if you look at Nigeria today, I think the biggest opportunities will come from those sectors where the government is taking active steps to drive change, to drive growth. You know, some of those sectors include agriculture. You can see the food scarcity that we've had. Any investment in agriculture now is really worth something considering. You are looking at sectors around infrastructure development, whether it has to do with water, electricity, or transportation as well. They provide good investment opportunities. And also, you need to look at technology and the role technology is playing in digitalizing a lot of the things happening in and around the country. I think those sectors provide very, very good opportunities for growth, and also not to underplay the role that financial services must play in bridging and connecting, the different dots and bringing savers and spenders together. So these are sectors that I think provide opportunity. So from a market perspective, the vehicles you can now use to take advantage of these opportunities are in the different products that are available, today in the space. It's really a mystery to see that our stock market has held up this year, despite us seeing interest rates at record levels. Stock market has held up. It's a surprise to me, actually, and I think it goes to underscore how well our market has evolved over the years and how strongly fundamentals continue to drive the market. So key names in these sectors I've mentioned are things one can put money into for long term. But of course, if you're investing in stocks, you must look further out rather than short term. Now, speaking to the fixed income side, treasury bills, commercial papers continue to be a very attractive proposition for investors now, because they continue to provide compelling results. Like we mentioned earlier, treasury bills, the yield on that are getting closer to 30 today, based on the last auction. But then when you look at that, 30 compared with your inflation, there's still some negative interest rate spread there. So the question most investors need to be asking is, how do I ensure that I beat inflation and miss, all of the opportunities we are seeing today? So that's why portfolio diversification comes into play here. So speaking to portfolio diversification, as much as the interest rate environment may not necessarily favor equities, I still think there is a compelling case for equities. If you look at many of the banks today, and as Ugo Dre and Mr. Babalola has also mentioned, still some of these banks are trading at a discount to what their true value should be. So I think this current rights issue we are seeing is a great opportunity to lock into some of these banking names for cheap. And I know that good growth will come out of that as you continue to hold these names over the long term. In balancing that portfolio, you also need to recognize the space for your short-term money market instruments, recognize the space for your long-term fixed income assets such as bonds, and how the interplay of these different assets can create a diversified portfolio that will withstand, economic challenges that we find ourselves in. Right. So in a nutshell, I would say every investor should look towards creating a balanced portfolio. And at Norrenberger, we have quite a number of products that can enable you express these different biases in the market.
Right. Thank you very much for that, and very valuable insights. And I'm happy with the comment you made about the banks, because I imagine many would be wondering whether or not they should go into the plethora of offers that we're anticipating from the banking sector. We'd like to now take some of the questions from that we can see in the Q&A field. First of all, I would like to just draw attention to the fact that we will only be taking questions from the Q&A field. I do see some participants are raising their hands. I want to encourage you to please type in your questions or comments in the Q&A field so that we can take them there. So with that said, I want to go to a question by Ebby. Ebby is asking, what reforms are in place or should be considered to create a more attractive environment for foreign and domestic investments? And perhaps, Rukayat, what kind of conversations are we having along those lines at the NEC?
Along which lines, please?
The lines of making foreign and domestic investments more attracted to Nigeria. So creating an attractive environment for these investments.
Of course, so to attract investment, of course, you need to de-risk the landscape, and you need to ensure that repatriation will be easy. There's certainty and stability. FX, if it's foreign direct investment, FX matters. I'm very glad with what I've heard based on the stock market performance, and generally the macro and fiscal environment to keep improving, and also that's for stock markets, but looking at real sectors and patient capital, because what you want to attract is patient capital. Yes, stock market is there, and for patient capital, the ease of doing business, there is PEBEC that continued under this administration, and also to ensure that port, for example, the single window program is ongoing, which has been a very important but problematic initiative. I was previously the special advisor on revenue matters, and I watched how the 8 years finished. And that single window that we know is very important for ease of doing business. It would vastly improve throughput at the port. It would vastly also save costs, all those demurrages and all that. So we just need to. The market is there. The market is there. It's to ensure these areas that will make us globally competitive for patient capital is addressed. At NEC, I mean, that's at the various states, they are the host communities to these businesses, wherever this thing, and that's why if you look at PEBEC, they do the state rankings, and every NEC agenda, of course, the economy is being discussed. The central bank governor is one of the only statutory members of the council, and it's to continue to push to ensure we're able to attract patient capital by de-risking and having a compelling value proposition that is globally competitive and, of course, sustainable.
Okay, thank you for your comments. Before I move on to my next question, I just wanted to reiterate that the presentation made earlier by Pabina would be made available by tomorrow. The actual report would be downloadable. So please stay tuned for more instructions on how you'll be able to get your hands on that. I want to go to Ugo Dre right now, and there's a question here about debt sustainability, which I think might become an increasingly important topic in Nigeria right now, given the high interest rate environment that we're seeing, and then, of course, the deficit levels that we're seeing as well. And the question here by Hamisu is, for how long do you think this government can sustain borrowing at this level? So a comment on borrowing levels right now from you, Padre.
Interesting question. I mean, I think it's a challenge for everyone. We've seen borrowings at levels that we never imagined that we would be maybe a little over a decade ago. I mean, we still remember how a lot of people celebrated our ability to clear our debts under the Obasanjo era. But now with public debt at over, I think it's over almost over 120 or so trillion naira and hitting $100 billion, about 91 or so billion dollars. And that's like the highest that we've ever been. Now, debt sustainability, to the specific of the question, well, it depends a lot on our ability to pay those debt. And if you check the metrics that they tend to use is two, you probably look at your debt to your GDP ratio, and then you look at your debt service payments or obligations as a percentage of your government revenue. And in terms of debt service to GDP, in terms of debt to GDP ratio, we're already 50% plus or so, and so more than what we'd always imagine was a buffer for us. I think a buffer for us was usually around 30-35%, and we used to claim then that, look, even in terms of debt to GDP ratio, we weren't anywhere close to our similar countries like, or emerging market countries like Nigeria. So, but we're already above 50%. So that is a challenge on its own, Wale, because now there's little room for borrowing or for increasing that number further. But the more pertinent one with debt sustainability is our ability to repay those debts, quite well. So our debt service to GDP ratio or to revenue ratio hitting, I think it was 70+% just recently. That is a challenge. We've seen it at 90-something%, because that means that most of what government earns, government tends to use it to pay debt. And that is a huge problem. That is why some of us were a bit worried with the latest supplementary budget that the government has put forward, because then we're already seeing our total 2024 budget hit close to 35 trillion. And most of that budget, Wale, is debt financed. And so what tends to happen when you have a lot of debt financed budget is, of course, that is due to sort of high fiscal deficits that we're incurring as a country. Government has to find a way to pay that debt. And the only way they can find to pay that debt is through either increased taxation or increase in government revenues. And we know that government revenues today is largely tied to crude oil, and a lot of it is outside of our control. Let's not even get into the issue of crude oil theft and our ability not to hit our crude oil production targets. But the key thing here is that you're going to see a lot more of tax ideas come up from the government. You've seen the windfall tax on banks move from 50%. National Assembly even moved that to 70%, giving you an idea of where these guys are thinking, because it kind of seems like they have a target already in mind of revenue they're trying to get. So you're going to see a lot of different ideas of taxation creeping here and there, and people are going to keep complaining, because at the end of the day, let's remember that the driving force for this is they have a very huge spending bill, and that spending bill is driven by debt, and that debt needs to be repaid one way. Right. On this question, people should also understand that it's not as if that we're at anywhere close to Ghana. I don't think we are, because so we can obviously always print naira to pay those debt. And of course, for the foreign debt component, a lot of it don't fall due imminently. And I think that the guys who manage our debt did manage it pretty well. So You can see that the spread is very well done. And so it's not an imminent threat per se, but the threat that I see, or the challenge that a lot of us here should start to plan for, is that you're going to see a lot of increased taxes come. This is just the first wave, and a lot more is going to come as time goes on, because the government needs to plug its fiscal deficits. Thanks, Oli.
Yes, thank you for that, Godre. So some really, really frank talk regarding the state of the economy and the government's fiscal position. So potentially more taxes coming. All right, let me go back to Mr. Segun Jaika there to reflect on another question here from Kelvin. He's saying, considering Dangote's past record of high pricing for his produce commodities, how confident can we be that allowing the Dangote refinery to operate optimally will drive down fuel prices and positively impact the exchange rate? Now, I imagine that you cannot comment for Dangote itself, but maybe you can reflect on this question. But I guess for me, the question in there is, what are your expectations about the impact of this Dangote refinery now that we are seeing signs that it is truly coming on stream in terms of its impact?
Okay, so thank you. I think to some extent I can speak for Dangote, because Dangote Industries Limited is my member, and is actually, he as a person is a vice president in charge of the large corporations group. So I want to clear some misconception. Dangote does not have a history of high prices. Dangote operates in an environment that is bedeviled by high cost of production, and a businessman must make his money. And there's no industry he operates that he doesn't have competitors. So you choose where you buy from. But the truth of it is that in terms of the investment in the refinery, I believe that he should be relied upon, because it's going to ensure availability. Is going to help our energy deficiency. Is going to save the country foreign exchange, because the product will be locally available. So optimal performance for the refinery is going to allow a situation where you save the foreign exchange that you normally use. And since it has been proven that is of a higher quality, it then means that the longevity of our machines and the processes that we use, the diesel, for instance, will be much longer. So I believe that it's a plus for the economy, and optimization of production in that refinery is actually a matter of national interest for Nigeria to be able to process, because we have 4 refineries that are owned by the NNPC. They are dysfunctional, and they are not supporting the domestic economy. If anything, we are importing. And we also have a situation where there are other small refineries too will come on board. I think the success of the Dangote refinery is going to encourage even other foreign investment in that sector, so that we'll be able to forever move away from the importation of petrol and all other commodities that are, all other items that are related to the petroleum industry.
Thank you. Thank you very much for that comment. I'd like to go now to Pabina. So someone is trying to get some practical advice. Akan is asking, in creating a balanced portfolio, please, what short-term assets and long-term assets should one watch out for? So short-term, to me, clearly, it sounds like it's a time to just buy those T-bills at the high rates. It just sounds prudent to do so. But then maybe you can reflect on the yield curve and how to invest across that, and then maybe also speak to the equity markets play as well.
Okay, so I think the very first question I would ask Akan, I think, is what is your investment objective? Why are you investing? People invest for different reasons, right? Some people invest because they want to save for their children. Some people invest because they just want to build wealth. Some people invest so that they want to save to buy a house, buy a car. There are a myriad of reasons why people would make an investment. So your investment objective is what drives the kind of portfolio you create. Having defined that investment objective, you now need to construct a portfolio that meets the need of that investment objective, right? So if you're looking at short-term assets in the current market today, your treasury bills, your commercial papers, even fixed deposits or your mutual funds, So at Norrenberger, we have different mutual funds to serve different purposes, and the yields are competitive on these mutual funds. They can all serve as instruments that you can use to anchor both short, medium, and long-term portfolio objectives. Then for longer-term assets, you want to look at your long-term bonds. I think now it's a great time to buy long-term bonds. And just take an example of this. If you're buying a bond today, a 20-year bond today at 20%, what that means is that you would earn 20% every year for 20 years if you hold that bond from now till maturity, right? So imagine if we go into a cycle where interest rates fall, you would still be earning 20% on that bond, maybe when interest rates are, for example, maybe 15 or 10%. So now it's a good time to buy into long-term bonds and lock in those yields. Equities are not out of it. They still continue to play a very vital role in diversifying portfolios and creating a well-balanced portfolio that one can use to drive your investment objective. So I would say these are the particular vehicles you can use. For more sophisticated investors, they can start looking at things like private equity funds, at infrastructure funds, because as the economy continues to grow, these kind of funds, these kind of vehicles provide very good investment returns for investors. So those are the options I would give to Akem.
Right. Quick one though, back to you. And someone's asking a very, it's pointing to this equity markets again here, and that is on the pricing of the rights and the market price. So James is saying, what do you think the outcome of the bank's recent public offer and rights offers would be, going by the fact that the prices they are being marketed at are almost the same price on the stock market and even higher than the stock price, for example, in the case of Access Bank, and he cites some pricing data there. So do you want to reflect on that?
Yes, you know, the market is used to a history of rights being offered at significant discounts to market just to create that incentive. But I think the very strong message that should come out of the pricing of these rights issues today is to tell you that the banks are telling you that we are fairly valued in the market, or we are still undervalued in the market, if you put it that way. I think that's the strong message coming out of banks in pricing the rights at the levels where they are. So if you look at some of the market prices to the rights prices today, it just tells you that for a lot of banks, they are seeing significant value creation ahead. If you take, I don't want to be specific on banks now, but some of these banks, when you look at the earnings mix of some of the banks today, you'll find out that the banks are far more resilient today than they were a couple of years ago. You know, so if you believe in the value of these banks, I think you shouldn't worry about whether there is a difference between the rights price or the market price. And I think another thing to look at again is for investors that want large volumes, these rights present an opportunity for you to acquire that kind of large volume. Because if you wanted to get that size in the market, you stand the risk of pushing the price, you know, much higher. So a good consideration for the rights, I think, is justified at these levels.
Speaking of offerings, maybe I'll go back to Mr. Babalola now. I know the NGX has recently launched a platform that allows people to invest efficiently in many of these offerings. Can you just speak very briefly to that?
Yes, thank you very much, Mr. Wale. I think for us at the exchange, at the exchange, you know, we believe and we leverage a lot on technology. And what we try to do is to remove inefficiencies and give value to investors. So that was why we try, and you will appreciate the fact that we've democratized access to our market, meaning people can trade using their mobile phone on the secondary market. So this time around, we're now focusing on the primary market, and that is why we went live with our IPO platform, where people can see the offers that are available. You can subscribe and pay for those offers. You know, we don't want a situation whereby you need to start going through paperwork again. And the good thing about this is that aside from the fact that on a portal, you can see all the offers that are available, you can click onto those offers. We are also using that platform to gather data from investors so that seamlessly by the time this offer closes, if there's anything like oversubscription and there's need to return money, we can easily at the click of a button, return everybody's money back to them. It also helps us in capturing adequate record of people who are participating in this offer now. If you participate and there's need for dividend to come, then we know the account to send your dividend to right now. So this platform is to make it a lot easier using straight through process for people to subscribe to current offers, and also it becomes a rallying point or a point where you can go and check whether other offers are available. And again, let me say this, going forward, you know, that platform will become a platform that if you want to know about any offer that is going on in the primary market, that is the point where you can visit. So the good thing about that platform is that it eliminates every paperwork, all the inefficiencies that is associated with this, even for the regulator and for the issuing house, for the registrars. The back end is also supporting them and assisting them to become more efficient. And in the long run, the question where we're going is that we want to also reduce the period it takes for an issuer to raise capital in our market. If we believe that leveraging on technology, we can actually achieve all these things. And at the long run, we're going to be able to address the issue of unclaimed dividend. We're going to make receiving of sales proceeds and returning of money to be within days. Allotment is also going to be efficient, because once the Securities and Exchange Commission and central banks approve those capital raised, at the click of a button, everything goes into your CSS account. So all these inefficiencies is what this platform aims to achieve, so that, you know, the capital and draw more people to be able to participate, because as soon as this offer closes, it migrates into your CSS account. It means it is available for trading. So all these are, you know, the focus, the aim of the NGS group in going ahead with this launch of this platform. And that was not the only thing we launched. We also launched the USSD, you understand, code, wherein if anywhere you are, with those codes, you can check data and get information about what is happening in the market.
Thank you. Thank you very much for the insight. And that's very useful information that I believe everyone can use as you consider your options relating to many of the offerings that are in the market now. I want to begin to wind things down, but I want to go back to Rukayat. There's a question here about the blue economy of Nigeria, and I wanted to hear your perspective. Very briefly, if you can, is there a timeline regarding Nigeria being actively involved in the blue economy? And the person asking is saying, I'm talking about utilizing the Atlantic Ocean and the Niger Basin and the southern region of the country to maximize economic stability and growth. Very briefly, if you can.
Thank you. Thank you very much. And I like that the question is around blue economy, because most times people focus on the green economy, but there is a lot of potential. I know that the Ministry of the blue economy is maritime and blue economy is trying to do the blue economy framework that helps unlock, you know, the opportunities of that economy. I know that the Ports Authority is trying to look at cabotage, you know, and all that. Even the maritime authorities is if you look at the IMO, it's largely built around SDGs, so it's something that, you know, cannot be avoided. It's a very valid way of diversifying the economy if you look at even the fishery potential. So in terms of the timeline, I'm not aware of the concrete timeline, but I know there is a framework that is under development for it. Thank you.
Thank you for that. Okay, so another question here. What exactly, Ugodre, maybe you can chime in on this. Help us better appreciate the situation. Jerry is asking, what exactly are the governments borrowing for? What capital projects in particular? Shouldn't these borrowings support projects that also generate income? So maybe you can help us appreciate the fiscal position of the government better.
Yeah, so a lot of our borrowings are used to finance both recurrent and capital expenditure, even though you would think most of that borrowing does find its way towards recurrent expenditure, because recurrent expenditure is typically or typically takes up a sizable portion of Nigeria's entire debt. And so, yeah, so most of those debt does goes towards recurrent expenditure. For example, the 6.2 trillion that they're about to pass has half of it going towards recurrent expenditure and the other half capital expenditure. And that has really been the case. Now, are there investments or borrowings that go towards capital expenditure? Quite a lot. Let me just give you an example. If you live in Lagos, for example, around the Ahmadu Bello Way, if you see that entire stretch of road, and that road was done with Sukuk bond. And that is one of those borrowings that the government has done. And
Right.
so if you look at Sukuk bond, so the road was built on an infrastructure, was used to build an infrastructure that a lot of people apply every day. And Sukuk bond today, I think, is ₦1 trillion or thereabouts in terms of the total debt Nigeria has taken. So the commensurate return for those sort of investment will usually be economic growth, because by constructing roads like that, then that sort of engenders economic growth, and then government can collect more tax revenues, which is what pays for those sort of roads. So yes, so that's essentially how those debts are used now.
Right.
Do we agree with it in totally? Maybe not, but that's a discussion for another day, Wally.
Well, at least you better help us appreciate that the type of projects that some of this debt is invested in. Okay, there's a question here from Mr. Babalola. If you can speak very briefly to this. Someone was listening to your earlier explanation and is asking, does it mean that all applications and subscriptions on the ongoing public offers and rights issues must go through the NGX platform at this time? Or are you just simply speaking to an option that investors can take? Just to clarify that point.
So thank you very much. I think what is important is we are aware of the fact that banks, stockbroking firms, and other people have also built their what we call APIs, application programming interface. So we're integrating everything. So if you go to your broker with your paper, the broker is expected to receive the paper from you, but they must convert your paper into an electronic form. That is the form that will come to us and go to the Asian house. So you can still go through your bank, the branch of a bank, your bank application, NSC platform. But what we're saying is at the back end, we will integrate and bring everything together in an electronic form, and it will go through that channel and make all the other back end of processes a lot easier, because the data capture are all in electronic form. So still go through the various channels that for those channels, they have their own application. They have a mechanism that they will use to convert whatever form you went to them into an electronic form that will make those processing a lot easier at the back end. So that's why I said one of the things you will see as an advantage is that going forward, and we're going to work with the commission and all the participants, that we want to reduce the cycle, the number of days that it takes for you to raise capital in the market. Got it.
Thank you for that. Now, just throw this open to all our panelists. Anyone can pick this up as we begin to wind things down. Philemon is asking, what impact will the government's recent decision to import food to the country have on our economy? And the second question is, what will the minimum wage increase the minimum wage increase result in too much money in circulation and consequently increased inflation? I was wondering if anyone wants to comment on that.
Okay, so I don't know.
Okay, Rukayat was going to speak to this. Rukayat, please go ahead. Before we come to you.
I agree that it's a valid risk to manage. Typically, minimum wage increase goes with monetary policy. I did see an initial question around inflation and how increasing the MPR and the CR has still not affected. Probably there might need to be some price control mechanisms or food subsidies. I saw Niger State, for example, has announced the plans to subsidize food items. But my own view, and this is my personal view, I think minimum wage should be on the concurrent list and not the exclusive list. I do think there should be the right sizing of the civil service. I do think, there needs to be reforms around eliminating ghost workers and all that to really make it work. But each state, my personal opinion is each state should be allowed to determine the minimum wage, because not all fingers are equal. Living standards differ across the nation. Thank you.
All right. Thank you. Mr. Jaikade, you wanted to chime in as well?
Okay, yeah, so maybe just a little one on the issue of the minimum wage. I think there's also, well taken the earlier comment, but there's also the other side of it being a positive development for manufacturing. Like I told you, we have more than 800 billion of unsold inventory. So we are seeing that if there is an increase in the earning capacity or in the disposable income of the average Nigerian, we'll see a shift in the pattern of consumer purchases. So it should be good for the economy so that we'll be able to leverage on the income we'll have from there, from the profit we'll make from there, to be able to deal with other issues. Don't forget that this is coming also at a time that the cost of production is rising. So if you see an improved performance in terms of consumer purchases, it will affect capacity utilization, and the reflation of the economy could be derived from it. So I think there's also a positive side to it.
All right. Thank you very much for that response. Okay, we still have quite a number of questions, but we do have to begin to wind things down. I'll take another concern about inflation and interest rates. Someone is asking, I'm concerned that somebody commented about the debt not being a problem. I believe that was when Ugodre was speaking. I think they have interpreted your response to mean that we don't really have a huge problem with debt sustainability. And the person is saying, since the Naira can be printed and debt paid, what about the impact on inflation, interest rates, and the exchange rate as we continue to see this increased borrowing? Ugodre, perhaps you want to respond to that point, because I think you were the one that made that comment.
What was the specific question?
Well, the person is more or less suggesting that you seem to be downplaying the debt challenges and the consequences of it in Nigeria.
Obviously not. No. Obviously not.
I think perhaps when you were speaking, you said something along the lines that it's not a crisis, maybe similar to what Ghana had and so forth. But I think the person is now saying that maybe if that may be the case, but then there's the interest rate impact, inflation impact, growth, sustainability impact. So maybe you can respond.
Yeah, so the person makes a very good point as well. So I think there are different ways to look at it. So I was speaking to debt sustainability and not necessarily the impact of growing debt or even fiscal deficits on the economy in the current. So if we're to speak about the impact of our debt levels on the current, oh, come on, I think that is pretty clear. I've stated time without number that whenever you have high fiscal deficits that we've been running in Nigeria for the better part of almost 2 decades, you'd always have exchange rate pressures. It's just how it works. Because then running a very high fiscal deficit suggests that you have government constantly borrowing to try and fund this business. And when you're constantly borrowing to try and fund your business, that also piles pressure on your exchange rate. And so by no means, the high excessive level of debt that we have in the country has clear impacts. And then, of course, interest rate. You've just said it now. We've said now, you heard Pabina say that you can't, this is probably the best time to buy treasury bills or corporate bonds at 20+%. That is a cost to the government. So if the government at a risk-free borrowing rate is borrowing at 20+%, then that means the private sector will always borrow at over 30%. And that, in a way, has an about turn effect on inflation, even though the high interest rate you're seeing is also done so that you can combat inflation. But the point is that if you're raising interest rates to reduce inflation and you're not seeing that translate into some sort of growth in terms of productivity, and then the purchasing power of people is not also increasing, at least to a large extent, to sustain the sort of growth that you're seeing, it just causes a spiral. And that is why you see that we're currently at a very, very delicate part of this whole process, where you need to start to see the monetary policy reforms start to align closely and better with the fiscal reforms, and then deliver the sort of results that we want. We're not seeing that now. Right. So, Ole, that's a discussion I'm not sure you want us to go into on this platform at the moment.
Well, I think we must give value to the audience. And my view on this is that, I haven't seen the latest numbers, but I do recall that there have been some presentations that suggest that debt service to revenue was almost at 100%. I think high 90s. I think that clearly, with the level that interest rates are at now, we must have breached that, and which means that we're spending more on debt servicing than an amount we make. Of course, maybe if revenues have picked up, then hopefully things are a little better. But anytime I think we have debt payments more than revenues, it's now become like a Ponzi scheme, because you're going to have to be borrowing to pay other people because you're not earning enough. So it's a huge challenge. I think more and more talk will be around it as the months go by, but it's certainly something to watch. I think that we must accelerate revenue. Revenue just has to go up, because we cannot continue to borrow at this price.
So it depends on what
it's not like borrowing at 6-7% like in the United States. You're borrowing at close to 30%. That is amazing.
Yeah, so that's the point. So is it, I mean, if we're looking at increasing revenue, is it going to be through taxes, or is it going to be through maybe crude oil exports? Or is it, I mean, what is it going to be? Because right now, GDP is at sub 3%, and you're seeing projections at maybe over 3%. That is still not enough to give government the sort of revenue that they want tax-wise, right? And then, of course, a lot of companies are already groaning in higher taxes because they're also struggling with higher interest rates. So it's not like the cash is there. So it's a bit of a catch-22 situation. And to your point, yes, debt service was actually 74% Q1. And of course, nobody knows what it's going to look like Q2 as we continue to pile on this debt. So it's a bit of a precarious situation. Don't want to be in their shoes, because it's not really easy what they're trying to achieve. But it's tough on Nigerians, Wale, and that's just the point.
For really me, tough. I think the solution, the immediate solution, is to cut the leakages. Make sure that we are increasing our revenue from oil. So the oil theft issue has to be addressed. We have to cut the leakages from all the other revenue sources, from taxes, from customs, etc. We've got to consolidate. I think if we can do that, we'll be in much better shape.
Boost productivity. I was expecting you would say that. So long as you rely on foreign...
I'm not saying the immediate issues. This ones we can immediately address, and then revenue to pick up. But absolutely, you're right.
But productivity is immediate. That's why I talked about GDP, that you have to boost productivity. Without productivity going up, it's going to be very difficult to have all these.
And taxing does not help productivity. That's the point. It does not help.
That's 20.
On the contrary, you need to cut taxes to increase productivity.
Certainly.
But, that is where we find ourselves. Okay, ladies and gentlemen, unfortunately, we're unable to take a lot more questions, but I'm going to appeal to our panelists to please just look through the Q&A field, and if you can just type in some responses as we begin to wind things down. But on that note, I want to say a very big thank you to all our panelists for their very useful and valuable contributions to this conversation up to this point. And again, many thanks to Norrenberger for organizing this platform. And I think on that note, I would like to now invite the Group Chief Finance Officer at Norrenberger, Queen Ehi Ujaman, to deliver some closing comments and appreciation of our panelists and guests. It's over to you, Queen.
Thank you, Wale. Thank you for such a great session, and thank you for moderating very effectively. So again, ladies and gentlemen.
Queen, if you can turn on your camera so we can see you if possible. Thank you.
Sure. Okay, my apologies. All right, ladies and gentlemen, as we come to the end of the Norrenberger H1 2024 Economic Outlook webinar, I would like, on behalf of the board, the management and staff of Norrenberger Financial Group, to extend our heartfelt gratitude to everyone who has made this event a resounding success. To our special guests and esteemed panelists, thank you for your insightful contribution and the perspective shared on the economic landscape in Nigeria and future trends. For me, I really noticed, the insights were very valuable, and I think I've gained one or two things from our panelists and the report's findings, and especially also from the research team. I believe these will be very crucial in guiding future business decisions for both individuals and organizations. Additionally, this has also served as an opportunity for the government and regulators to gauge public sentiments following the notable reforms that have been implemented in recent years. So a very special thank you to you, Wale, for moderating very expertly. And you've coordinated this event very well, and it's ran smooth, and we found it very engaging, and we're really most grateful for that. And for our participants and audience, thank you. I saw the questions. People were really engaged, asking, thoughtful and very thought-provoking questions, which has been beneficial to every one of us. So thank you for your participation and engagement. It's made this very successful. And we hope you found the discussions informative. I personally did. And, we need to finally continue to engage, collaborate as we navigate the economic challenges and opportunities ahead. So we believe together we can drive growth and progress in our various sectors. So once again, thank you everybody for joining, and have a great day. So I'll hand you over to our team, and you guys can take over. So thank you, everyone.
Many thanks, Queen, for that. And thank you again to everyone for joining us for this interaction. I'm going to now invite Amani Momodu. He is the Group Head Strategy and Business Growth, Norrenberger. I think he has a few words to share before we close out.
Yes, and thank you, Wale. And again, our appreciation to all our esteemed panelists as well as distinguished participants. Right, to further express our profound gratitude, we want to take a moment to ask our participants to kindly put on their cameras for a photo opportunity. And if photo opportunities there is. So we'll be grateful to have everybody put on their cameras.
Also, I believe the groups CEO also should do so.
We are taking counts.
Everyone.
And then the shoot has started.
Okay. Yes, okay. I think if you can just adjust your camera, yes.
All right. I think my digital team is ready, and they are already clicking away. Just give us a few seconds more to get this done.
All right. On 3, 1, 2, 3.
Okay, I think we got everybody captured, and again, our gratitude and special thanks to all of us for an hour and 46 minutes well spent. The moderating was expertly done, just like Queen said, because we kept within the time allocated for every segment. Thank you all, and God bless. We'll see you on the next one.
Thank you. And we do have some information about how you can download the report. It's on the screen now, so please take advantage of that. And many thanks again to everyone for joining us, and we look forward to having you at the next event. Cheers.